Okay. Hi everybody. Welcome to this webinar. I'm Angelo Ranaldo, and I hold the chair of Finance and Systemic Risk at the University of St. Gallen. This webinar is part of a series of 5 guest lectures related to my master class on systemic risk and financial stability. These are open to all those may be interested in this topic, so you are welcome to join today's lecture and the remaining ones this week every afternoon at 3 p.m. to 5 p.m. Central European Standard Time. So today the special guest is Dr. Thomas Moser. He's a specialist in central banking and financial stability. He studied at the University of Zurich, where he graduated the PhD in 1997. Then he started his career at the Swiss National Bank, and then he had several positions at the IMF, including the executive director or a member of the Committee of Global Financial System at the BIS. Since 2010, Thomas is member of the governing board of the Swiss National Bank, and the lecture today is going to be about cryptocurrencies, stable coins, and central bank digital currency. So thank you very much in advance for your attention. Maybe I pass the word to Alex.
Yes, just very quickly from my side, some organizational things. Thomas is very happy to take questions at the end of his talk, and we have this Q&A feature in the webinar. So at the bottom, or if you use an iPad, I think it's at the top, you have the Q&A, and there you can type in your question. And I will try to coordinate in the end and let Thomas know your question, so we can have a Q&A session in the end. Apart from that, you have if you are here now, you have found the right link to enter this session, and it will be the same link for the whole week. So just every day at around 3 p.m., you can click on this link and you will find us here having our webinar series. So now I'm going to stop sharing my screen and hand over to Thomas.
Okay, thank you very much, Angelo and Alex. It's a real pleasure for me to be here in this series, and I will start with, as you said, digital currencies, stable coins, and central bank digital currency. So let me try to share my screen here. So I'm doing this here from the safety of my home office. I hope you can see now the title page. Okay, so I have to find the right button here. Okay, now it works. So cryptocurrencies, where this is actually a culmination of a quest that has started already in the 1980s, a quest for digital cash when using computers. And I guess most people in this seminar here are too young to remember that computers before the 1980s were really something very different than they are now. They were entire rooms in universities. And then the rise, of course, of the personal computer in the 1980s, and also the rise of the internet did lead to this quest for digital cash. The internet itself started as really a military project. It was decentralized from the beginning because the whole idea was to have basically a network of computers that would not be vulnerable to a single point of attack in case of a real military attack. So the army started to build that together with the universities. The US Army really lost interest, one could say, in the 80s, and the universities took over. It became really a network among universities. And then in 1991, they decided to open it up to commercial use. And that's when you really had a need to make payments on the internet. So that's not that long ago, at least for me, probably for most of you. But before 1991, you could not use the internet for any commercial purposes. And in the same year, there was the launch of the World Wide Web, which made it much easier to surf the internet. Now, the first proposal for digital cash to be used through computers to make payments on the internet came from David Chaum in 1983 with a paper called Blind Signatures for Untraceable Payments. That was followed up by him and his co-authors in 1990. And David Chaum was actually even implemented a payment system with, you could say, a crypto digital cash system, which he called eCash, that worked, and some of the banks, even including Deutsche Bank, did implement that in the 90s, but it did not become the main payment methods of the internet. As you all know, what instead became the payment methods was the credit card. And nowadays, if you pay something through the internet, you really do it most of the time with the credit card. Now, the big change came again in 2008 when Satoshi Nakamoto published his white paper, Bitcoin, a peer-to-peer electronic cash system, which showed a new way to make payments without the use of a credit card system, with this cryptocurrency called Bitcoin. 2009, it was implemented, and since then, of course, it has become a really big story. Central bankers were kind of watching that, but it was small, it was growing. I will say a little bit more about the regulatory concerns later. And then I think another game changer was the white paper of Libra in 2019, which I think worried a lot of the regulators, because there came now a firm Facebook behind it, and especially with WhatsApp behind it, that had the potential to scale very quickly and become a very widely used payment, not just system, but they even had proposed, at least in the first version of their paper, to come out with their own currency. Now, peer-to-peer quickly, and I will say something about payment methods. I mean, if you have a peer-to-peer system, that's what Nakamoto had in mind, was something like cash, where you really pay from person to person. One person gives the money to the other person and receives the goods or services, which is very different from, for instance, when you use the credit card or any kind of banking system where you need the banks as intermediaries, where you also exchange the goods somehow directly, but the payment really goes through the banks. If they both have the same bank A, then you can, then the bank A can internally credit one account, debit the other one. But if not, then it has to go even more cumbersome through the central banks, who clear it through the accounts that the banks have with the central bank, before it then goes to the person. So you see, it's a relatively complicated system, and also therefore relatively slow and relatively expensive. Now, in general, you can say, and that's not entirely equivalent, but basically you have two types of payment systems. You have, on the one hand, these account-based systems. That's just the last one we looked at, where you transfer money by charging the payer's account and do it the way we just described, and use the pay's account. So basically, it's from one account to the other account. That's how you pay. You pay with your bank deposit, and you access that bank deposit, for instance, with your credit card, with a debit card, with a wire transfer, and so on. The other system that we looked at, the cash-based systems, would be a token-based, or sometimes also called a value-based system, where the transfer occurs by transferring the value or a token that represents the monetary assets directly. For instance, a banknote, you just hand that over. Now, there are some people who say that this differentiation doesn't really make a lot of sense when it comes to digital currencies, because you cannot really differentiate that neatly. I would politely disagree here, and say, yes, you should differentiate, because what the key difference here is the information that is carried by the information asset. Now, in an account-based system, you need to know the identities of the people involved, and you have an account that is associated with the transaction history. So that's essential, that you have the transaction history recorded. You need records. If you have a token-based system, like if you think of banknotes, then the token itself carries information about its value and the entity that has issued the token, but you do not need to know anything about either the payer or the payee. They can be absolutely anonymous. The only thing you have to make sure is that the token, the asset that you transfer, that this is that this is not has not been forged, that it is a real value asset. Now, I make this point especially because Bitcoin, and probably some people usually disagree here, is an account-based system. If you take this definition, because it has a ledger. The only new thing here is that the ledger is distributed, but you still have transaction histories involved on the blockchain. That's the whole point of how you verify transactions and how you make sure that you are the owner of the Bitcoin, is because you can prove it through the transaction history of the specific Bitcoin you're talking about. So the novelty here is not that it's not account-based. So in that sense, it's not peer-to-peer or token-based like cash. What's really new is that the ledger is not held and updated by a centralized institution like a bank, but the ledger is distributed among all the participants. So that's what's really new here. Now, how did that? What are the ingredients here to this to cryptocurrencies, and especially Bitcoin, which is the first and still most successful of all the cryptocurrencies? One was was cryptography, as the term itself, or the name cryptocurrencies itself suggests. And here the big step really was the change from symmetric cryptography to asymmetric cryptography in the 1970s. So cryptography is in general has to do with the encryption and the decryption of messages. And before the Diffie-Hellman paper in the 70s, there was really only symmetric cryptography, which meant that you had one key. You needed the same key to encrypt something and the same key to decrypt something. And of course, one of the difficulties was that you had to give the key to the other person in order for that person to be able to decrypt it. And that itself was a security problem, especially if you had to hand over the key, let's say, through the internet. So the idea of asymmetric cryptography was that you have two different keys. You use one for the encryption and you use a different one for the decryption. And the neat thing is that you do create both keys at the same time. And what you can do is you can take one key, namely the key for encryption, and publish that on the internet. That is the so-called public key. That's why this asymmetric cryptography sometimes is also called public key cryptography. You can give that key to everyone and say, you can encrypt a message for me with this key. So anyone can see that key. And the beauty is that only you who has the private key can decrypt. So everyone can encrypt something with that key. The message that comes out is totally unlegible for anyone. You can even post that message again on the internet, and no one can decrypt it without having access to the private key. And you never have to exchange a key with any other person. So that's also what Bitcoin is using. There, the private key is how you access basically your account or your address, and the public key in Bitcoin is your address, so your account that you can post on the internet. Now, the other thing you can do with public key cryptography is to use it the other way around. You can sign something with your private key, and everyone can use the public key and verify that it has been signed by you, because you are the only one who can sign it. You're the only one who has access to the private key. So that was actually what David Chaum used in the 80s to create his eCash system. So that's not new, but that's a very important ingredient into the cryptocurrencies and into the Bitcoin story. Another ingredient, of course, is the blockchain itself, where you take different transactions, you put them all in a block, and then you use a cryptographic function called a hash function. This is basically a way where you can create a very neat digest of a message of any length. And in this case, you use these different transactions, you put them all in a block, and you hash the entire block. You combine that with the hash of the previous transaction history, and you get a very neat, very compact digest of the whole transaction history. And these hash functions here, an example, these are the same hash functions that Bitcoin uses, this SHA-256, which, by the way, is a hash function that was developed by the Secret Service in the US. And you see here the properties of the hash function. So so one property is that if you just make the slightest little change to the message that you are hashing, then you get a very different hash. And that makes sure that you can detect whether someone has tampered with the content. So if someone changes just one transaction in one block, then the entire hash of the block will look different. And as an example here, I took my own name and hashed it with the SHA-256 function. If I take Thomas Moser, you get this hash on the right, with starting with 447 BD and so on. If I take Thomas Moser, but now don't take a capital M for Moser, but a small m, then you see, even though there is only a very slight difference in the message that I'm hashing, I get a completely different hash, starting now with 12A8 and so on. The other thing that is also noticeable here is that there is no way to go from the hash back to the message. It's not really clear what the message is that you have hashed. And the other property of hash functions is, as I said, you can take basically a message of any length. And as an example here, I took the sentence, die Schweizerische Nationalbank führt als unabhängige Zentralbank die Geld- und Währungspolitik des Landes. So I took that entire sentence, put it through the hash function SHA-256, and I'm getting, you see, a message that has the same length, the exact same length as if I take Thomas Moser. So I could do that with an entire book or an entire library. I would always get the same length output. So a very powerful cryptographic function that gives me a neat little digest, and the digest is unique. So I get, for every message, I get a different hash output, and that's what's used in Bitcoin. And the other thing, and then I'm stopping soon about Bitcoin here, is this proof of work that is used to make sure that everyone has the same version of the ledger. So before I said the real novelty here is, in terms of payment system, is that we have a distributed ledger, distributed among all participants. Now, what is new, what is really, I think, revolutionary about our Bitcoin is that it solved one problem that in distributed computing was around for some time. So that the question of if you distribute a database among different nodes in a network, how do you make sure that everyone has the same version? How do you make sure that everyone updates the same way, that everyone updates in the same order? So that has been a very old problem, and it has been basically solved for a closed network. If you know exactly how many nodes there are, then there are different ways how you can do that. Most common way is that you have basically something like a voting algorithm, and you just take the majority of all the nodes. What they have is the new version of the distributed ledger or distributed database. Now, what's really new with Bitcoin is that Nakamoto solved that for a open network, where everyone can join and leave as they want. We do not know how many nodes there are. It can change every day. So that has not been solved before. And an important ingredient to how to solve that is this proof of work. And what he suggested here is that you have, before we saw the hash of a block, so basically you have, apart from the previous hash of the previous transaction histories and the transaction histories that you put into the block, these TXs here, you have also something called a nonce, and that you have to, that's the so-called puzzle that you have to solve. You have to find a number here that gives you a certain hash as a result. And there are certain requirements for the hash that you have to get when you hash that entire block. And you can change that hash by changing that nonce, but there is no way there is no algorithm that tells you how to do that to get to the hash that you are supposed to get. And that hash usually has to do with a certain number of zeros that you need to have in the beginning. And the only way you can do that is by just trying out all possibilities. And that is what the proof of work or mining does. You just, by brute force, try all the possibilities until you arrive to the hash that you need. And if you do that, then you are the one who can suggest how to update all the ledgers in the network, and you get the mining reward, you get the newly minted Bitcoins, but you only get those if the others then basically attach their new blocks to the block that you did. So you have an incentive, of course, to do it right, that your block will be recognized as a legitimate block, and that the chain will continue with your block. Only then you get your reward. So the way Nakamoto really solved this is not just through technical devices, but also through incentives. And I think the whole incentive design is very important to the whole way that Bitcoin works. And there are some people who say actually it works better in practice than in theory. So, but it's a clever combination of technical solutions and incentives. So that's how Bitcoin came into existence. And I think what's probably the puzzle for economists, if you look at the literature, then it's clear that, for instance, a fiat currency like, let's say, the Swiss franc, there is at least since the 70s or even a bit earlier, there's nothing behind it. I mean, there's just a trust that you have in the central bank, but you cannot get anything for, let's say, 10 Swiss francs, then maybe 2 5-franc pieces or 10 1-franc pieces, but you cannot get gold or silver or anything like you used to. And I think most economists believed that in order for something to get value that is intrinsically not valuable, it needs to have a history like fiat currencies, where they once had an intrinsic value. You could exchange them for something, but then just out of habit, people continue to use them. But I think Bitcoin really proved this theory that you find implicitly in a lot of the histories of money wrong, in the sense that it started as being nothing, having no intrinsic value, but suddenly in 2010, barely 1 year after it came into existence, someone was suddenly ready to accept Bitcoins for pizza, as the story goes. The first transaction was 10,000 Bitcoin for 2 pizzas, and it suddenly started to have value from then on. And quite dramatically, as you see in 2014, this is now the Bitcoin price in US dollar. Everyone knows the story here. We all know that the extreme price increase in 2018, where 1 Bitcoin was almost $20,000. You hear a lot about, or you heard probably a lot of the stories of people who started Bitcoin mining early on and became extremely rich. You usually do not hear so much about the people who bought Bitcoin at 20,000 a piece and then lost a large part of that. There are also stories about that, but the price volatility or the bubble, you can say, that we had in 2018, the price crash, and now the increase again, the high volatility, of course, that's one of the concerns that regulators had, and that's when Bitcoin got noticed. And there was, of course, a concern that given that this looks like a very highly speculative asset, that people who cannot afford to lose money in these amounts are buying Bitcoin and losing money. So the whole first, I think the first attention that Bitcoin got from regulators, apart from its use for like, let's say, buying drugs and the whole Silk Road episode, where it had more to do with criminal activity. The first concern really was consumer protection, investor protection. How do you deal with the volatility? And the second, of course, is after Bitcoin had that huge price increase in 2018, a lot of other altcoins came into existence already before, but then I guess there came the real boom. And of course, there was also a lot of fraud involved. A lot of coins were issued that where there was really no intention to have something, to start something like Bitcoin, but the intention was to make quick money and abuse the willingness of people to put money into schemes because they hope to get rich. So regulatory concerns had not anything to do with monetary policy concerns, but really with investor protection, fraud, and criminal activity, because Bitcoin was used in the early years for several of such transactions. Now, where does cryptocurrency fit in if you look at different types of money? Sometimes it's said that the issue here is that we have privately issued money, which is clearly one attribute, but that's nothing new. If you look at the types of money that people can use to make their payments, that's really in the bottom line here. So people like you and I, we can use banknotes that are issued by the Swiss National Bank, by the central bank, or we can use our deposits that we have with commercial banks. But those deposits with commercial banks, that's also private money. That's money issued by a commercial bank. The difference to cryptocurrencies really is that, first of all, of course, commercial banks are heavily regulated. Exactly. One reason is because they issue their own money. But the other also is that these deposits that you have with commercial banks, the commercial banks promise you that you can redeem that in central bank money. So you can go to your bank and you can ask for banknotes, and you get an exchange rate fixed at 1-to-1. You can get the same amount in banknotes. You can pay in, you can pay out, you can make transfers, that it's all fixed 1-to-1 to the money issued by the Swiss National Bank, by the central bank. The commercial banks themselves, they have access to a digital form of money that is issued by the central bank. And these are the deposits that the central bank provides. But these are only available for commercial banks and not for the public at large. But that's also a version of digital money that is issued by the central bank. that is used by commercial banks exactly to settle payments among themselves. And then you have on the right here cryptocurrencies, and that's not really clear who issues that. In the case of Bitcoin, there's really no one. It's the network that issues the currency. You have other cryptocurrencies where you have a private entity behind that issues that. But so that's clearly now something new that is different than the usual deposits or banknotes or deposits by commercial banks. But the new thing is not that it's private money. Private money already exists in the form of commercial bank deposits, but they are of course heavily regulated. That might be one road that we are traveling down with cryptocurrencies. Now, money in general, a lot of times the question comes, is Bitcoin at all, money at all? So, I mean, the economists usually define money as a medium of exchange, unit of account, store of value. And the really distinctive feature here is medium of exchange. I mean, store of value, yes, that's very an important function of money, but that's not really distinct. So there are a lot of other store of values, assets, except apart from money. Unit of account, usually the money, the medium of exchange is the unit of account because it's convenient. But there are a lot of examples, Chile, for instance, where that is not the case. Or you also know it from countries where you have very high inflation. A lot of times then the unit of account is US dollar or euro, but you still pay in the local currency. So the really distinctive feature of money is that it's a medium of exchange, that it is commonly accepted as money. And there, of course, there are some question marks with cryptocurrencies. Bitcoin is the most widely accepted cryptocurrency, but it's also clear that you cannot pay everywhere. That if you go to Migros, Coop, I guess most of the time you still have hard time paying with Bitcoin. But clearly that's it has been increasing as a medium of exchange. So the most of the money is used, as I said, are banknotes or commercial bank deposits. And so the difference, and I think that's an important difference when we come to central bank digital currencies, is between central bank money and commercial bank money is whose liability is it? And that has a lot then to do with risk, with counterparty risk. So central bank money is a liability of the central bank, and it is not redeemable. So you, as I said, you cannot get anything for it, but maybe the same money in other denominations. But it has no counterparty risk because the central bank can always regard this liability, given that it itself prints that money, and given that it does not have to exchange that for anything else but its own money. So in that sense, there is no counterparty risk to central bank money. How is the value preserved? It's preserved by the central bank's monetary policy. Commercial bank money, on the other hand, is a liability of the respective commercial bank. So you have counterparty risk there. If a commercial bank where you have your deposit goes bankrupt, there is an issue. We have, of course, backstops like deposit insurance and so on, but there is a counterparty risk involved. That's also why usually when you have a systemically important infrastructure, you want to have payments settled in central bank money, exactly for this reason, because you want to take out the counterparty risk. Now, cryptocurrencies, as I said here, it's not clear or very different on whether it is a liability or not. So Bitcoin is no one's liability. It's also not redeemable. But we saw one issue was that the price volatility is very high. So that's why over the last maybe 2 or 3 years, stable coins became more and more popular. Now, what do stable coins do? Interestingly, is it's like a step back in the history of money, because they try to stabilize the price in 2 ways. So one, the most popular way is by trying to link the value to another asset. or a portfolio of other assets. Tether, for instance, is an interesting example. The most popular one that is linked to US dollar. Now, the way that was done, at least in the beginning, and is often done, is that the issuer of the stablecoin holds collateral. And in the beginning, the promise was that there would be 100% collateral. So for instance, for each Tether coin, there would be $1 held somewhere in an escrow account or in an account somewhere. And I said before that this is a step back in the history of money. So basically, that's how banknotes started. Banknotes nowadays are issued by central banks, but in the beginning, this was really an invention of the private sector. Commercial banks issued banknotes, and you could redeem those. You could exchange those banknotes again for the gold that you had in the bank. So they were also 100% collateralized. Of course, like always, if you need to hold 100% collateral, that's a relatively expensive business model. So there is an incentive to reduce the amount of collateral that you hold, to go to a fractional reserve system. And that's what you also now observe with a lot of the stable coins. They start with 100% backing, and then they move away from 100% backing. And of course, the further they move away, the riskier it becomes. They can have liquidity issues, namely if it's redeemable and everyone wants to exchange it again into US dollar or whatever, then there might not be enough of the collateral to do that. But of course, it's an issue of profitability. So Tether went exactly that way. They changed first to a fractional reserve system, and then they even stopped redeeming at all. But they are still the most popular stablecoin. But these are some of the interesting issues that are, again, for regulators to consider, because the whole story resembles a lot the story of commercial banks with banknotes. And there, of course, the story was that you had these issues, you had these bank runs, and then the regulation started. First, you would tell the banks how much collateral they would have to hold against their banknotes. And in the end, banknotes were nationalized and nowadays issued by central banks. So this is also one possible avenue, that you have more and more regulation on stable coins, and maybe eventually even a nationalization through central bank digital currencies. Now, a second way to attempt to stabilize the value of a stablecoin are so-called algorithmic stablecoins. And these try to not stabilize the value by linking it to other assets, but basically by imitating central banks. So they try to issue and withdraw coins in order to stabilize the value. Now, interestingly, there are some new bits, for instance, is an interesting case. Usually they are stable until they are not. So I might not be don't know the latest of all the developments, but there is no algorithmic stablecoin, to my knowledge, that has really achieved the promised stability over a longer time period. Also, because it's very difficult to achieve. Maybe one other word I didn't mention now, Libra. The way I understand them, so I would put them into the stablecoin that try to link the value to other assets. The way they seem to do it is that they have a number of authorized entities that can redeem the Libra coins that they intend to issue against the collateral, but not everyone can do that. So only a number of authorized entities. So that looks very much to me like an exchange-traded fund, where you make sure that there are some players who do the arbitrage to keep the value to the underlying assets, but you do not allow the public at large to redeem it. So this, at least what I understand from the second white paper, seems to be the way that Libra wants to issue their own stablecoins. And maybe also one little twist here, there are now, especially also in Switzerland, with the crypto bank Signum, some stable coins that use as the underlying assets directly central bank money. So they use their account. So all the licensed banks can have an account with the Swiss National Bank. Signum is one of the few licensed crypto banks, so they have an account with us, and they use that to back their own Swiss franc stablecoin. The IMF has called these kind of schemes, when the stablecoin is backed by central bank money directly and not by commercial bank money, they have called them synthetic CBDCs. I wouldn't go that far because, again, for me, the difference is whose liability is it? So these are, even though they have an account with the Swiss National Bank and use that as collateral, it's still a liability of Signum Bank and not a liability of the Swiss National Bank. And accordingly, it has counterparty risks involved. Even though, of course, they are lower than when you use a commercial bank deposit as collateral, where you have not only the counterparty risk of the issuer, but you also have the underlying risks of the commercial banks that holds your deposit. Now, central banks, of course, I would say over the last 2 years, that has become now more and more a topic for central banks. When I started to get interested in cryptocurrencies, maybe 5 or already 6 years ago, I was the almost only one who usually showed up at such events from a central bank. But that has clearly changed over the last 3 years. And there are 2 schemes that are discussed in the central bank community. 2 types of central bank digital currencies. One is so-called wholesale CBDC, which would be similar to the bank deposits, so the deposits that commercial banks have at the central bank. So a wholesale CBDC would be available only to selected financial market participants, especially banks, but not to the public at large. Now, all the examples that I see, the pilots and so on, they're all based on distributed ledger technology. And I use here the term purposely DLT and not blockchain, because you remember I told you before that the real innovation of Bitcoin and what a lot of people call the innovation of blockchain was that it solved the problem of how do you make sure that everyone has the same version of the ledger in an open network. So all these attempts of wholesale CBDCs, they are not being done on open networks, but they are being done on closed networks. So they don't use the innovation that Bitcoin brought. Basically, they go back to the solutions that have already been here before Bitcoin, namely how you do that in a closed network. And you have commercial providers like R3 with the Corda DLT or Hyperledger by IBM. They're all closed or permissioned DLTs, where you have a relatively small number of known participants, and there you don't really have the same issue like you have in Bitcoin. It's much easier to get consensus on the status of the ledger, because you basically have you know each other, you have trusted entities that are involved. Of course, if you do that, now the question becomes, what's the advantage of doing that? And here, I guess it's the advantages that are often in post-trading. You have a shared ledger. You do not have to update your data individually and check whether you have the right version. You have the same version as others. Basically, you have a shared distributed database where technologically it is securely made sure that you have the same versions. So there might be cost savings involved here, but I think this is still an open question. We had a lot of nice papers coming out, let's say from the Bank of Canada, from the monetary authorities of Singapore, the European central banks and others. They made experiments to replace their RTGS systems, so their payment systems among banks, with DLT and the wholesale CBDC. And I think all these experiments show, yes, it's possible, it works, but it's not really more efficient than very modern RTGS. At least as long as you do not find a good way to deploy smart contracts. So at this stage, I think that the race here is still open. The Swiss National Bank itself, we are also conducting an experiment together with SIX, with the Swiss Digital Exchange, SDX, and we are issuing our report probably in December. So there we have the situation that the Swiss Stock Exchange has created a DLT version of a stock exchange, the SDX, and they intend to go live next year. And we checked out together with them whether it would make sense or whether it would be efficient if we, the Swiss National Bank, issue a wholesale CBDC on that DLT of SDX. But we also made a second proof of, so this is only a proof of concept. We have not decided yet whether we will go live with them. That's a decision that is totally separate. But we also made a second proof of concept and checked whether it would also be possible just to link the DLT of SDX to our RTGS, to our traditional payment system. And as I said, we will issue our report in December. Now, the second and much more, I think, controversial issue is whether central banks should issue a retail CBDC. And the retail CBDC here is defined as a CBDC that would be available to the public at large. That would really be a digital version of the banknote. Now, if you go into the literature, the big risk that a lot of economists and especially also central banks see is the risk of disintermediation of the banking sector. So the risk is that if you can choose between holding a central bank digital currency or a bank deposit at your commercial bank, there is a certain risk that a lot of people would switch to the CBDC, which of course would take away funding from the commercial banks. There's also a risk that this would especially happen in bad times, like 2008, 2009, exactly for the reason that I mentioned before. You do not have counterparty risk. The Swiss National Bank will certainly not go bankrupt in a crisis. So there is a, sorry for this. So there is a risk here that that you have this disintermediation. Let me try to fix that while I'm okay, sorry for that. So there is a risk here, but you have also a number of economists who say that this is totally exaggerated, that this risk is not existent. For instance, you have a paper by Brunnermeier and Nippelt, which you will find easily if you Google it, even if you don't know the title, just Brunnermeier and Nippelt 2019. And basically they say, well, you know, if that happens, the only thing that central banks have to do is just to put that money back with the commercial banks. So it's not really an issue. It depends a lot on how central banks deal with this. And then there is another paper by Alexander Berenson and Chair who take a different view and say, well, you know, probably it will make the banking sector safer because the banks are aware of this risk and they will have to come up with better business models and prove to the people that that the commercial bank accounts are safer, more convenient, and so on. So it will improve it will actually improve the banking sector, and not make it or not put it at the risk that it will disappear. And then you have also other proposals who say, okay, that is a risk, but there are ways to deal with this. And you have Kumhof and Noon, for instance, and Binzeil. So one of the proposals there is that you use negative interest rates, or at least the interest rate that is clearly below the interest rates that commercial banks pay on their deposits. Right now, it would have to be negative, given that commercial banks pay 0. But you would basically have, let's say, always 1 percentage point or 2 percentage points below what commercial banks pay. So people would not hold all their money in CBDC. So basically, the whole idea is here that you make it less attractive CBDC. To mitigate that risk. There are also other proposals that you put limits on how much people can hold in CBDC, which of course brings their own problems, kind of like you have with capital flow restrictions and so on. There are proposals that you can only exchange it against certain types of assets and so on. They all make it a little bit complicated, but there are a number of proposals out there how to mitigate that risk. But I think the general question, and also the question that I think the Swiss National Bank has asked often, is what really is the value added of a retail CBDC? Do we need a retail CBDC? I mean, that's a fair question. You can say, okay, everyone in Switzerland, and there might be a question that is answered very differently from country to country. But let's say for Switzerland, you could say, well, commercial bank money is totally sufficient. You can pay easily with debit cards. You can use Twint. You can use Revolut, whatever. Do you really need a central bank digital currency? And I think Thomas Jordan has been out there saying we don't really see the value added, so it's not really that necessary. Of course, you could, as counter arguments, you could say, well, there is no counterparty risk involved with CBDC, so maybe it's a good idea to give people the opportunity to also pay with CBDC without counterparty risk. You could say, well, I think it's important that there, apart from private issuers or suppliers of money, there's also state money. That's, for instance, a position that the Central Bank of Sweden has taken. You can also argue privacy, and I think that's something I will say something about later, because if you want to pay privately, then the only way nowadays is with cash, with banknotes. Now, there are different arguments why it's important that you have such an option to pay privately, especially in a world increasingly governed by big data and private companies that have the possibility to really use that data. Your transaction data, of course, is very interesting to them. So should central banks provide a CBDC that gives you a certain level of privacy? So these are all, I think, open questions that I think reasonable people can argue differently. Central bankers, as I said, the last years became more and more interested in the issue. Here, this is a chart that I have taken from a BIS working paper, and you see how central banks started to talk about CBDC. You have here different colors. You have a negative stance in red below. You have a positive stance on CBDC in blue. You see that the central banks mainly started out being very negative about CBDCs and the need for CBDCs. You see that changed around 2019, and you also see in a darker blue all the speeches they gave about retail CBDC and the positive ones, and the brighter blue positive about wholesale CBDC. But you see that this has really, let's say, only this year changed, that it has become a little bit more positively mentioned in central bank speeches, but it clearly is becoming a big issue. Now, if we now, so as I said, wholesale CBDC, that would not be that revolutionary because it would only be available to a limited number of participants. It would also not be that revolutionary because they also already have access to digital version of central bank money. The real new thing, and what really would be a new type of money and much more revolutionary, is retail CBDC. So let me close with some words on retail CBDC and CBDC designs. I think what changed now this year, the conversation among central bankers switched from do we need a CBDC to if we were to issue a CBDC, how would it look like? And there are different types of designs. The most simple way to do that would just to be to basically open up an account for every citizen. That would be an account-based CBDC. Now you have proposals, Binzal, Berenson, Share, they all say that's the way to go. If we want to have a retail CBDC, just give everyone an account. It's technically very simple. We just have to open up the accounts beyond the entities already having an account. Now, of course, there would be a lot of details involved. One issue is, of course, that the central bank would become responsible to perform KYC and anti-money laundering, counterfeiting, terrorism regulation, and so on. But several people like Berenson and so on, they say, well, that could easily be outsourced to commercial banks or to other service providers. So the central bank wouldn't have to do that on its own. Now, one risk, of course, that would entail, is mentioned by some people, is that if everyone pays through the central bank, has an account with the central bank, there is a huge potential for mass surveillance and then abuse of data. Now, some people say, well, that's not so much of a problem. The central bank, we all trust the central bank. The central bank would have the data. We trust that the central bank keeps that and doesn't give that data to the politicians who might want to abuse the data. I would argue here that even if this is true, it's a threat to central bank independence. Because the central bank could clearly come under pressure to give this data to the government, to the Secret Service, and so on. So this is an issue that would clearly be a negative about such a design. And then, of course, another issue is the whole disintermediation risk we talk about. That would, I think, with this design, that risk would be greatest because the central banks would be in direct competition with commercial banks. You can choose whether you have an account with the commercial bank or whether you have it with the Swiss National Bank, with the central bank. So there, this risk will clearly exist and you would have to address that. Now, a second way to do a CBDC, and I would be much more in favor of that, and I will show you afterwards a proposal that I have with some of my co-authors, which is not a proposal by the Swiss National Bank. The Swiss National Bank stance is that we do not need a retail CBDC. So this is a pure research work. But that other design would be a so-called token-based CBDC. We talked about token-based payments before. So that would really be the perfect version of a digital banknote. Now, the problem with all these tokens is that you need to make sure that that this token cannot be copied, and this is exactly the most difficult thing to do with digital currencies. And as I said before, Bitcoin doesn't need that because it is an account-based system. The difference just is that the accounts, so that the ledger is distributed, but you also keep track of payments through the ledger, through the accounts. That's how you make sure that these tokens are not, or this Bitcoin are not copied. So that's the so-called double spending problem. If you have really a token without accounts, without transaction history, then you have to make sure that they are not copied. And this is something that is basically impossible. You can do it with hardware-based tokens, but with software-only tokens, this has, to my knowledge, not been solved to this date. I will show you a way how in our proposal we attempt to solve this issue. And of course, if you achieve that, if you achieve a purely token-based CBDC or digital currency, the question becomes, how do you guarantee KYC and AML CFT compliance? How do you, because like with cash, you have people who can remain anonymous. And how do you make sure that they comply with all the laws? And this, again, this would be really anonymous, not like with Bitcoin, where you have a transaction history, where you have pseudonymous accounts. You have this, as I said before, these public keys, but these public keys are addresses. You cannot connect them to a real world identity of someone, but you have an address, and if you do enough research, as for instance several of the secret agencies have done, you can sometimes manage to link these addresses, these public keys to real persons. So this here, a token-based CBDC would be really anonymous. Now, as I said, this proposal, and I hope that we can issue our paper relatively soon. This is a paper I co-wrote with David Schaum and Christian Grothoff from the University of Bern of Applied Sciences. David Schaum is the father of cryptocurrencies. He's the one who came up in the 80s with the eCash system. And we have a paper that we have entitled How to Issue a CBDC, a Retail CBDC. It's under review. We hope we can issue it in the Swiss National Bank Working Paper Series, but we are still waiting for it to be cleared. If not, we will probably issue it somewhere else. But the idea that we have here is that we have a retail CBDC based on asymmetric cryptography. Basically, what we do is we update the eCash system that David Schaum already had in place in the 1980s and 90s. That was further developed by student Dold, who made out of that what is called the GNU-Talos system. And we basically take this and apply it as a CBDC. It was done as a commercial digital currency system, both Schaum and Dold, and we just take that system and use it to issue a CBDC. It is, as I said, it's based on asymmetric cryptography, but not on a blockchain. So I think that's also one thing that is very different from a lot of proposals out there. We do not use a blockchain for our CBDC. And I think this is for me, an interesting question. A lot of times when I talk to people about CBDCs and ask them, why do you need a blockchain if you have a central bank issuing a digital currency? So there is a central institution already there. If you trust this institution, and I guess you do, otherwise you wouldn't have it issue a CBDC, then you do not need to distribute anything. You use a centrally issued CBDC, and that's exactly what we propose. So the advantage of distributing the ledger of the central bank is not really clear to me, and I have not received a very good answer to that. The only two are, well, we don't trust the central bank, but if you don't trust the central bank, I don't think you need a CBDC, and you are better off with Bitcoin. The other is it's more transparent, because then we can see what the central bank is doing, that the central bank is not stealing money. And here my answer is, well, we have a lot of traditional external review. We issue our accounts and so on. That might not be very transparent to people working in IT. But I can also tell you that the blockchain is not that transparent for economists. So Also here, I'm not really seeing the extra gain that you get. So what also is, I think, very different is that we achieve with our proposal really perfect, even quantum-resistant transaction privacy by using David Chaum's blind signature schemes. Now, a lot of times when you look at CBDC proposals based on DLT, then you find that they have sometimes proposals how to protect privacy. They are a lot of times based on very advanced and difficult cryptography, zero-knowledge proof, and so on. You also have cryptocurrencies based on that, Zcash, for instance. They all have in common that they are computationally extremely difficult to do. A lot of times you cannot do them, let's say, on a mobile phone. And that's a problem that then that is, I think, specific to the blockchain. In our system, where we do not use a blockchain, these blind signatures are very easy to compute, and that's not an issue at all. And I can also say that our proposal has actually been deployed at the Bern University of Applied Sciences in the restaurant. So there is a little snack machine where you can buy with our CBDC. The computer science faculty of the Bern University of Applied Sciences plays Swiss National Bank, Central Bank. There you can, they issue the CBDC, and you can then the cash register at the restaurant of the university plays commercial bank. There you can exchange banknotes for the CBDC, and then you can pay through your phone with the CBDC. So it works. I have tried it out myself. If you ever want to try it out, you just have to go to the Bern University of Applied Sciences. And now the way we do it is also, it's also a trick between, or a mixture between technical solutions and incentive solutions. So the way our system works is we have the central bank centrally issuing CBDC to the commercial bank at the request of the customer. So as a customer, you could go to your commercial bank, and we did it exactly like cash. So like nowadays, you can go to an ATM and get out 100 francs, then that will be taken from your account. The same you could do with the CBDC. Basically, you exchange CBDC for money that you have on your account. So you need to have an account to get the CBDC. And that's exactly how we guarantee KYC, AML, CFT. So when you withdraw the money, the bank knows who you are, you have a bank account, but when you get then the CBDC, you can use that CBDC anonymously. You can pay someone else, a merchant, and then you have full transaction privacy. So no one sees that what you paid, that you paid. So your identity in the payment process itself is totally anonymous. So you do not have to worry that anyone knows what you paid with. You also do not have to worry what the merchant is doing with your data, because the merchant doesn't have any of your data. But then, I told you before, the big problem with token-based CBDC or any token-based digital currency is how do you make sure that they are not copied? Now, there are some technical devices that try to do that. We do not even attempt that. So we do not attempt to stop anyone from copying it, but it's here now an incentive design. The merchant receiving the CBDC, the only way he can make sure that this is not a copied CBDC, some CBDC has already been spent before, is by depositing it. So he or she have to deposit it immediately with their commercial bank. The commercial bank then forwards that CBDC to central bank. And the only thing that the central bank does, it keeps a list of all already spent CBDCs. So the central bank does not have any information about the transactions. It only can check whether this specific serial number of a CBDC has already been spent or not. If it has not been spent, then the OK comes back, and the commercial bank, well, then deposit the CBDC for the merchant. So that's the trick used here to prevent double spending and at the same time guarantee transaction privacy and KYC AML CFT, which of course is again here guaranteed because the merchant has to deposit it. Now, could the merchant not deposit it? Yes, but then he doesn't know whether the customer turns around and uses the same CBDC to pay for something else. So it's really an incentive issue here for the merchant to deposit it. Now, what's also special about the scheme is that we propose that the central bank, by issuing this CBDC, establishes key pairs. So for each denomination, so you would have a key pair, so a cryptographic key pair for, let's say, 10 franc, for 20 franc, 50 franc, and so on. And what is special is that these keys have an expiration date. Now you may wonder why would that be the case. So basically we do that for two reasons. One is it keeps the system very efficient because the central bank does not have to store and search an ever-growing list of spent coins, but you only have to keep them for certain years. Then they expire and you don't have to worry about it anymore. So it keeps the whole system very efficient. It also reduces security risks because you do not have to worry about an ever-growing list of coins that or keys that could be hacked. But also here you have basically you exchange or you have new private keys every year, for instance. Now, another option that gives you, if you have an expiration date on those keys, is that you could also, if you want, but that's not a necessity, but you could apply negative interest rates very neatly and easily with such a scheme, in that you would just ask people who haven't spent their coin, let's say within a year, they have to exchange it then for a fresh coin, very similar as with the car, where you have to get a new thing for the highway, that you have to pay a certain fee if you want to exchange them for new coins. That's of course how you could apply if you want negative interest rates, but that's not necessary. But it just gives you this option too. Of course, also the other way around, you could also get a discount and have a positive interest rate on it. So that's just an additional policy option that you could get with this scheme. And by the way, that's also not that outrageous, the whole idea with expiration dates. The same applies to banknotes. As you know, we have a new banknote series maybe every 20 years, so that the cycle is relatively long, but there also comes a time when the central bank says, okay, all the banknotes will not be valid anymore from then on, and you have to exchange them. Here, the cycle would be much shorter, let's say a year, or you can use any cycle that you want to use. In terms of scalability, also here, I think one advantage of that proposal would be that it's not blockchain based, and therefore you do not have the scalability issues. You probably have heard a lot about stories that Bitcoin can process maybe 6-7 transactions per second, whereas Visa can do several thousands per second. Now, the system that we propose could also do several thousands a second. It would be the same ballpark like Visa, and exactly, of course, because it's not using a blockchain, but it's a centrally issued CBDC. We also checked with the costs that would entail, and when we used Amazon prices as a benchmark, then transactions would be in the order of $0.0001 per transaction. So that is very cheap. That would be in the same ballpark as what the Swiss National Bank SIX system costs for banks making payments among them. So in terms of scalability, the system would also be quite favorable, exactly because it is centrally issued and not based on a blockchain. And so that would be the end of my comments, and I would be happy to take questions from here.
Okay, great. Thank you. I'm not sure, Angelo, if you wanted to say something.
No, I think you can maybe take the question of our students if there is any.
Yes, so there have been a couple of questions. I will just start with the first one as they arrived. So the first one was about Tether. And the question is Tether similar to pegging a currency to the dollar? And if yes, could this be an alternative to skip the trilemma from a monetary policy perspective?
So I think in the beginning, so I mean, two things here. In the beginning, yes, I think it was pegging, or the idea is exactly to peg it to the dollar. So it's like a currency pegged to a dollar. The question is, how can you achieve that and how can you guarantee that? And of course, if you look at the story of pegged exchange rate, then more often than not, you have an accident somewhere down the road. And the accident happens, of course, if you cannot fulfill your commitment to exchange your currency for the other currency. So you have to intervene somehow to keep the stability of your peg. And that's exactly, I think, one of the weaknesses of these stable coins. And especially if you could say, if they hold 100% collateral, that's like a currency board. Let's say Hong Kong. That is very safe because they can always pay out the dollars that are needed to keep the currency pegged. If you do not have it 100% collateralized, of course you can run out of collateral. And that's, I think, what happened to Tether. But Tether went a step further, and you cannot even redeem it. So it's not freely. If you would again put that on a currency scheme, basically you cannot freely exchange the currency for other currencies. So it's much more artificial in the sense, and difficult to keep the value where it is supposed to be.
Good, thank you. Second question, and I'm trying to summarize it. It was actually two questions or two comments, but it boils down to the question: do you think COVID will accelerate the introduction or the adoption of digital currencies?
Now, I think that's an interesting question. It is clearly possible that it increases the adoption of digital payments, but whether this also means digital currencies, I think, is a different issue. If we look at our own transaction data, it's clear that during spring, people paid more with credit cards, debit cards. So that's also a digital form of payment without using cryptocurrencies. And there is a question whether whether this is all coming back, whether people will use more cash. What we have seen then in summer is that people used more cash again. So I think the overall effect, the long-term effect, is still open. But I think it's quite plausible to argue that there will be more digital payments. But as I also said before, there are a lot of like, let's say, if you use Twint, for instance, or if you use the contactless debit card payment, I think a lot of people also got used to that. So you do not necessarily. It doesn't necessarily mean that we go to cryptocurrencies and that the CBDC is needed, because there are various ways to do digital payments, even with the current systems.
Okay, the next question is also quite interesting because this was also a popular idea in Switzerland. The question is, could you maybe share some of your thoughts about the Vollgeld-Initiative, how it's called in Germany, since I think they do share similarities with CBDC?
I fully agree that there is clearly a common factor there. And I think that's, interestingly, one of the reasons why I would say we in Switzerland were a little bit ahead of the thinking about CBDC compared with other central banks, was exactly because we went through the Vollgeld-Initiative. And if you think of the scheme where everyone has an account at the Swiss National Bank, that's basically one of the ways that you could have implemented the Vollgeld-Initiative. Of course, you would have also had to restrict what commercial banks can do. That would have been the other part. But there are clearly similarities to the Vollgeld-Initiative. I mean, the Volksinitiative would basically have forbidden the commercial banks to take to run a fractional reserve system. So a CBDC would not forbid them to do that. They could continue their business, but it would, of course, provide basically a type of Vollgeld to the public at large if we would have a retail CBDC.
Okay, then 2 questions to go. There was one question by Tom Burdorf, who asks, how quickly would the merchant have to deposit the CBDC to the commercial bank? And I think this was related to your suggestion.
Yeah. Well, I mean, if you want to be sure, and especially if a stranger pays you, I would do it immediately. So that actually is possible to do and to check with the central bank within seconds. So this is a process that can basically, you use your phone. Your phone does that for you, transmits it to the commercial bank. The commercial bank transmits it to the central bank. So that can be done within seconds. The only requirement is that you have to have connection to the internet. I think that's one of maybe the weaknesses of our proposal. It does not work offline. You need to have to do this check. You need to have access to the internet. There are David Chaum has some ideas and also implemented them in the 90s, how you could do that offline, but it just makes everything much more complicated and increases the risks that you have, because it is not only the risk that, so basically his scheme would, once you go online again, would do the check, but that might be also already be quite late. And even if he had a very clever scheme how if then there was a double spending, the identity would be revealed of the payer, which makes it, of course, cryptographically much more complicated. But even if you know who the person was, you still have to go through the legal system to get your money back, or to get to somehow get get your goods back or whatever, but it just makes it much more complicated. So we did not implement that. So in that sense, it had to be immediate. But of course, if you trust the person, let's say if I give such a CBDC to the pay from my phone and give it to the phone of my child, there is no reason for my child to immediately deposit it, because I guess the child would trust me that I will not go and double spend the same CBDC. So within like a family or maybe even a circle of friends, you wouldn't have to immediately deposit. But if you deal with a stranger, I guess it would be your incentive to do it immediately.
Okay, there just arrived one more question about your proposition of a CBDC. So maybe I'll take that. And then we have one last question about the issuance of CBDC in general. So one question by Mathieu. In your proposed CBDC structure, would every token spent in a transaction immediately expire and the amount credited receive a new hash, even though the amount is the same?
It would immediately expire. Yes, that's right. Basically, it would go then on that list. So the hash, so the serial number, basically is the hash of the public key. That's one of the differences to Bitcoin. So in Bitcoin, the key pair, the public key is the address or the account. And as you rightly say, in our scheme, the public key would be the actual coin. So the hash of the public key would be the actual coin. So that would go on the list of the central bank, against which the central bank then would have test whether a coin has already been spent. So it would be immediately discarded, lose its value, as you said. It would be deposited the equivalent of that amount to the deposit of the merchant. And the only thing that the Swiss National Bank or the central bank would hold is this list of hashes of already spent coins. Correct.
Okay, so thank you again for your time. Last question. It was actually 2 questions, but I'm trying to summarize because both were related to issuing or the issuance of a CBDC, and the question is when CBDCs are issued, and usually on the asset side of a central bank, you issue money against government bonds, and this might lead, in the case of a CBDC, to something like a safe asset scarcity, because you have to purchase all the government bonds as a central bank. So this was one question. Then another comment was then related to this: could you maybe issue a CBDC without holding any government bonds on the asset side and kind of profit from the full seigniorage?
I mean, that's a very good question on exactly how you would issue it against what. And one of the papers that I mentioned, Kumhoff, Noon, they talk a lot about that, against which assets you would issue them. But there's also the possibility, and our proposal would be that you actually have a switch on the liability side. So the only thing that we would do is on the liability side, we have banknotes. We have basically we would just exchange banknotes for CBDC. So it would stay on that's the way we would do it. So this is also a possibility, but I think that's a very interesting question on against which assets or which liability switch you would do, how you would exactly issue the CBDC. I think these are all the design questions that have to be looked at.
Okay, thank you, Thomas, for answering all these questions. Thank you also for the viewers and listeners for asking the questions. And then I would hand over to Angelo maybe for some closing remarks.
Yeah, no, I would like to thank you very much, Thomas. Was really, I also like it a lot, the historical background of this evolution. This was really good. So thank you very much for your insights, and I invite you to come to join the next webinar, maybe tomorrow, if you are interested. And I wish you a nice evening, everybody. Bye-bye.
Thank you very much. Thanks for having me.
Thank you. Bye-bye.